Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with my old friend, Chris Mayer. Chris is probably the best investor I know who came out of the newsletter publishing world. Wonderful guy, great investor, lots to talk about with him. This week in the mailbag, lots of love for last week's interview with Lawrence Lindsay. And we have questions about gold, crypto, life insurance, and life, liberty, and the pursuit of happiness. And remember, the mailbag is a conversation, so talk to me. Call our listener feedback line, 800-381-2357, and hear your voice on the show. In my opening rant this week, I'll talk about emotions and trading. We have to do it sometime. Let's do it today. That and more right now on the Stansberry Investor Hour. Why talk about emotions? Well, because they can lose you a lot of money. You know, from an investment perspective, that's why you want to talk about emotions. And I just want to focus on one thing. And that one thing is how bad we are at knowing how we'll feel when some future condition is met. There are positive and negative examples, right? So we think, maybe, let's just say, we think something like, wow, if I just had an extra $100,000, my problems would be solved. I'd feel wonderful. Life would be so good. Then you get the extra 100,000, and within a day or two, you're like, and it's the same thing when we think we need something new. I wish I had a new car, you know. And when I was young, when you're young and you don't have anything, you really learn about this. If I just had a new car, everything would be so much better. You get the new car for 24 hours, you're bragging about it and showing it to your friends, and then you feel like, doesn't matter so much. And the negative examples, well, wait a minute, let's just do one more positive example, because it's not just that you kind of don't appreciate how much that $100,000 will, kind of not mean anything after a day or two. It's more than that. And I would go so far as to say, from my personal observations, even if people work very hard for it, when you make, life-changing money, let's just say, whatever that is for you, 5 million, 100 million, I don't know, 500 million. In general, people tend to behave differently and not so great. And I think it's just too difficult to handle it. It's just really hard to handle a gigantic sum of money. And that's why we, kind of make rich people into heroes. If there is a legitimate reason to do so. One of the reasons is that it's hard enough to make a whole lot of money, life-changing money. It's really hard to hang on to it. I've seen so many people get windfalls in their lives, and just their behavior changes, and they start spending money like a drunken sailor and start behaving in different ways, and life kind of goes downhill for some period of time. It's unusual that doesn't happen. And so if you're successful as an investor, you wake up one day and go, wow, I have all the money I'll ever need, hooray. And then, you got to be careful that you don't behave differently from that point on. And the negative examples are when the big negative example is when the market drops 30 or 40%, right? We're bad at knowing how we'll feel and how we'll behave when that happens. We think, oh, I'll be okay. I'm disciplined. I'm a good investor. When the market drops 30%, I'm going to invest my cash and buy on the big dip or whatever, right? I'm going to buy value. I'm going to do whatever is right. I'm going to buy when the market's down. And then the market drops 30 or 40%, and the news, well, we could use a real example. We don't have to make one up. Then the news is, there's this COVID pandemic, in March of 2020. Oh, wow. How bad is this going to get? The world's shut down. They shut down the world. They're never going to open it up. So, you start panicking and you start feeling a lot differently and behaving differently than you anticipated you would. So knowing how to handle your emotions turns out to be like one of the most important things. Even the father of value investing, Ben Graham, said, your biggest enemy is not the market, it's yourself, right? And many people have said the same thing. And I came upon this, every week I try to think of something that a topic we can't avoid, right? These are topics, I'm trying to hit topics we can't avoid. Last week I talked about inflation. You can't avoid inflation. Over time, it is a relentless force. We must talk about it. And people have been talking about it a little more lately, so I know it's probably on your mind, and it should be. And emotions are the same way. And how you'll handle, wonderful things that happen to you and bad things that happen to you. You'll probably handle them differently than what you currently anticipate, unless you go to some trouble to do otherwise. Great traders, and I was thinking about this because we're going to put out a book of some of our interviews, and I was editing some of it, or some of it was edited for me, and I needed to go through it and go behind and make sure everything looked okay. And I was looking at the Jack Schwager interview, and it was a great interview with Jack Schwager. Great guy, lots of wisdom there for years and years and years, interviewing all these great traders. And Schwager talks a lot about emotions because all the traders that he interviewed, except for one, they all say, everything that they do as a trader is to get emotion out of the equation, right? It's so that they can just hone in on what's important and not let their emotions cause them to make a bad decision. And he reminded me in that interview of a piece that was actually on 60 Minutes about 10 years ago, I think in October 2011. It's called The Ascent of Alex Honnold. Alex Honnold is that young guy who climbs basically small mountains and rocks, big rocks and small mountains. I mean, he climbed a 3,000-foot cliff. That's a mountain to me. And with no ropes. He does free, he made a movie. There was a movie made about him called Free Solo, and he uses no ropes, and he climbs up these things. If he falls, he dies. It's crazy. And the beginning of that interview on 60 Minutes back in October 2011, Lara Logan was the interviewer, and she said, at the very beginning, the first question, do you feel the adrenaline at all? And Honnold said, there is no adrenaline rush. If I get a rush, it means something has gone horribly wrong. The whole thing should be pretty slow and controlled. And then he said, it's mellow. Okay. So if that exercise needs to be mellow, if everything you do in that needs to be mellow, then, and if it can be done, he's like the one person in the world who can do it. Maybe we can learn to control our emotions as traders, because I know a lot of you listening to the sound of my voice right now are actively trading in and out. I'm not a trader, but I read a lot about traders and various things that traders do because I think it's important. And one of them is they control their emotions. How do they control their emotions? What do you do as an investor or a trader to control your emotions? Well, you have a plan. You know what you're going to do ahead of time, no matter what. And with traders, the basic thing they do to control their emotions is they have a system that identifies entry and exit points, and they don't care how they feel. It doesn't matter how they feel. If their system indicates an entry, they enter the trade. If their system indicates it's time to exit, they exit the trade. There's no feelings involved. It doesn't matter if you won or lost on the trade. It just matters if your system said you should enter here and exit there. And if you're going to manage your money with your hand on the stick, you're not just putting money into a 401k and putting it in an index fund and leaving it at that. You're really buying and selling individual stocks actively, or options, or whatever it is. You must have some kind of a plan like that. You must know under what conditions what am I looking to buy? When will I buy? And under what conditions will I exit? When do I sell? And those are the basic things you do. The other thing that these traders do is they position size. How much? They know when, they know how much, and they know what, right? They're trading futures, they're trading options, whatever it is. So they know what, when, how much. They answer those basic questions about how they're going to operate with real money. So that's why emotions are important, because they can wreck you. And also, the reason they can wreck you is because you're very bad at knowing how you're going to handle them in the future. And if you don't have these kind of plans and you know what you're trading and when you're entering and when you're exit, under what conditions you're doing all of this stuff, you will make a mistake, a potentially big one. And, none of these traders make big mistakes because they all control their position sizes and their entry and exit. They don't let a losing position go on. Peter Brandt is one of these market wizard guys, and we interviewed him on the show. And he has this rule where he says, if the trade is not, if I'm not ahead, if I'm in a loss on a trade on a Friday, I don't hold it through the weekend. And he said that, Schwager told me about that, and he said, it saved him a ton of money over time, because you never know what's going to happen for 2 days while the market's closed, and then you wake up Monday and you get a small loss on a Friday can turn to a big one Monday morning. So that's a rule that Brandt likes to follow, right? So control your emotions. And my quote of the week is related to this topic. I was going through a book. I actually read a book called Mastery by Robert Greene, and I didn't anticipate that I would like it, but I loved it. It had lots of great biographical type stories about people like Leonardo da Vinci and Freddie Roach, the boxing trainer, and some other folks. And it was really an excellent read, and I would recommend Mastery by Robert Greene. But I came across this quote in there that floored me. He said, "The need for certainty is the greatest disease the mind faces." The need for certainty is the greatest disease the mind faces. And that falls hard upon all this emotional stuff, because a typical novice trading situation is, you think that chart patterns give you 100% certainty, so you bet your whole wad, and then you're down 50%, and you say, well, the chart pattern, blah, 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 I've got certainty, so I'm going to hang on, and then you're down 90% and you lose it all over. That's a typical thing. Whereas real traders say, I'm never going to bet more than 0.5% or 1% of my portfolio on any individual trade, and I'm always going to cut my losses quickly. Right? So those people, they're never out of control. They never make that novice mistake. They're highly disciplined, and their emotions are taken out of the equation. The need for certainty is the greatest disease the mind faces. If you don't understand that your need for certainty is screwing you up, you can get into big trouble. Great quote, really great quote, and a good book. All right, that's all I have for you today. Let's go talk to my old friend Chris Mayer. Let's do it right now. So I need to talk to everyone seriously here for just a minute, because right now we're in this weird emotional market with a lot of fear and greed controlling what the average investor is doing with their money. That's why we're seeing a lot of money pouring into crazy investments like NFTs and meme stocks and penny cryptos. People see the market still near record highs, and they're scared of getting left behind. They want to be part of all the hot money-making stories we're hearing right now. But really, for most people, unfortunately, it's a bunch of crap. You're probably going to lose everything chasing speculative gains like that. Just ask someone who bought AMC stock or a bunch of Dogecoin a few months ago. It's the exact opposite of how I approach investing. That's why I'd like for you to check out a new video I just posted online at extremevaluestock.com. In the video, I'm sharing details of a fantastic risk-averse value stock opportunity that my research is showing could return about 200% over the next 24 months. I'd love for you to check it all out by heading over to extremevaluestock.com. But please hurry, because the stock I'll be telling you about is getting close to exceeding my buy up to price recommendation. And once it does, I'll probably have to take the video offline. So one more time, to learn the details, head over to extremevaluestock.com today. That's extremevaluestock.com. Very much looking forward to today's interview. Chris Mayer is one of my favorite people in the whole investment universe. What can I say? Chris is the portfolio manager and co-founder of Woodlock House Family Capital, a private investment fund. He has written 4 books, including 100 Baggers, Stocks That Return 100 to 1, and How to Find Them. And most recently, he wrote How Do You Know? A Guide to Clear Thinking About Wall Street, Investing, and Life, which won the 2019 SI Hayakawa Book Prize, awarded by the Institute of General Semantics. Chris has traveled to over 30 countries in search of great investment ideas. Chris, welcome back, man.
Hey, good to be on with you, Dan, as always.
Yeah. Well, I don't think I knew about the Hayakawa Prize, so much belated congratulations on that.
Yeah, oh, thank you. I mean, that book, it's a more intellectual kind of book. It's not it's not 100 Baggers, I tell people, but it's kind of a funny story, because when I went to present that to a publisher, I presented the idea, and they thought it wouldn't sell, and they were right. but but it did get some attention in some areas. So it was nice to win the Hayakawa Award. That was a nice appreciation for it. And it was one of those books I just had to write myself. I had it in me, it was bursting out, and I had to get it done regardless of whether it sold or not.
Yeah, so I remember asking you about this topic of general semantics, and I know nothing about it. You recommended some books, and I don't remember if I bought them or not. They might be in here somewhere. I have too many books. But what the heck is general semantics? What is it?
Yeah, it's kind of a hard thing to describe, because it's a sort of a broad discipline. But I would say the way I think of it is it's kind of an aid to critical thinking, and it has a lot of different tools and that help you sort through problems. And so it started with a guy named Alfred Korzybski, who wrote a big, fat, difficult book about it called Science and Sanity, which came out in 1933. 800 pages, a lot of footnotes and math. I wouldn't recommend anybody start with that. But there are a lot of other smart people since. I mean, Hayakawa wrote some very accessible books about it. Wendell Johnson, Neil Postman wrote a book called Crazy Talk, which is very accessible. Irving Lee. So there's been other people about it, but it generally deals with how we use our language and how different models affect the way we think. So I know that's sort of general, but I guess that's the best I can do.
No, I'm kind of grateful that you didn't get any more technical than that. It sounds like you can really get very deep in the weeds of an 800-page book that's about, as you described it, and it has math in it.
Yeah,
I mean, so
yeah, imagine that.
Interesting. Yeah, I mean, math, and it's kind of about language and problem solving and things.
That's it. Okay. That's it, exactly. Yeah, I like that kind of stuff. I mean, even now, I just I picked up a book called Maxims for Thinking Analytically: The Wisdom of Richard Zeckhauser, who's a Harvard professor. And it's very similar. It kind of reminds me of some of these things, because he has lots of little maxims and ideas that will aim to improve your critical thinking. So, yeah.
You also mentioned Neil Postman. Man, yeah. I'm a fan of Neil Postman.
Me
His
too.
books are all very accessible.
Yeah, I love Neil Postman stuff. I've read most of his books, and I guess he's most famous for, help me out, Dan, you know the one I'm talking about.
Amusing Ourselves to Death.
That's it. Amusing Ourselves to Death is the one he's most famous for, and that's the one I would recommend recommend to people to start with. And once you read that, you can find your way to the other books.
Right. Yeah.
But there's a lot of great social criticism in there, things about technology. And I think the big idea I came away with from Postman, which is an idea he took from Marshall McLuhan, is this idea that, and McLuhan's aphorism, the medium is a message, where how we communicate impacts what you can say and the kinds of messages you can deliver. So I remember Postman's extreme example of this was he said, smoke signals, if you use smoke signals, it's hard to talk about philosophy when you're communicating by smoke signals. And that makes a clear case where the medium impacts what you can say. And I think about that a lot in the context of, say, Twitter, which I'm active on. Twitter, the medium itself, certainly impacts what you say. People are trying to get likes and retweets and favorites and their followers. And then there's the character limit. So certainly it impacts the kinds of conversations you have, what kind of topics you discuss and bring up. I mean, all these mediums have that kind of impact.
Yeah, weak-minded fools like me get on Twitter, and it's just straight into the gutter. I mean, it went from like value investing and bottom-up equity analysis to like, screaming about climate change and stuff. It just it went straight downhill.
Right. Well, the system encourages you to do that, because those are the kind of statements that are likely to get more attention too. And I noticed that my own use of it has evolved greatly. I remember in the beginning when I was still stumbling around and not sure what to do with it, I'd be one of those guys who would put personal things on there too. I would say I would have pictures of where I was, or what I was eating. People do that. I stopped doing that long ago, thankfully. But I use it now pretty much strictly for business. If I'm reading something that's interesting, I'll put it on there. If I read something that I think people will like, I put it on there. There'll be days at a time where I don't tweet anything, and then I might be on there and tweet 3 or 4 things. So I've learned to manage it now. I have kind of a love-hate relationship with it, because on the one hand, I hate that it sort of draws you all the time to say something. You have all these followers, and you just feel like you could waste a lot of time on there. I mean, I've had times where I'm sitting on Twitter and 40 minutes goes by, and I'm like, what have I just done? I just wasted a bunch of time. It's like junk food for the mind. But when you manage it well, I think it can be a useful tool. I've met a number of interesting investors through Twitter. We've shared research and notes on different names. So from that standpoint, it's been valuable.
Yeah, you can cultivate a really good Twitter feed if you want to.
Yes.
You can put people in your feed that are, consistent and high quality, and I believe that I do have a pretty good one. But you know what? Humans are humans, and it doesn't matter how much you cultivate, like, the lower brow sort of topics and comments, it always comes in there. And I call them lower brow on purpose, because I feel like it pulls me down. I feel like, IQ points are draining as I'm commenting.
Yeah, exactly. Yeah, I agree with that. Sometimes you feel dumber.
Yep. So
for having been on it. But it's also, the other thing is, I talk about investors who I've met. I mean, it's a global network. So and it has this button where you can easily translate tweets. So I've been researching companies in Sweden, and I've been able to talk to and converse with investors over there that I probably would otherwise have had a hard time finding. Same is true. I remember I was looking at a name in Mexico, and I've got a good relationship there with a pretty smart investor in Mexico now. I mean, just about anywhere in the world, if you're looking and you just share a little something about what you're doing on Twitter, somebody may reach out and say, hey, I know that name, or, this or that. And you've got a great contact.
Yeah. And I have to say, just for our listener, Chris has a great Twitter feed. I mean, it's really, he's much more disciplined than I am, and it's all business, and it's really, really well focused on bottom up investing ideas.
Well, thank you, and I try. I mean, it's by design. It takes a great deal of discipline, believe me.
Oh, I get it. Believe it. And I'm the guy who, I get disciplined right after I failed to exercise. I'm never going to do that again, right? But I did notice your most recent tweet, and it was you were retweeting something about the Swedish version of a company with the ticker symbol. It's a Canadian company
Yeah,
called
Constellation Software, CSU.
Yeah, yep. So this is an interesting company to me because I've covered Constellation Brands, the alcoholic beverage company, and people will tell me they'll be talking to me about Constellation. They'll say, "Man, that thing is up so much," and I'll think to myself, "Oh, it's done well. It's done okay." And then then they'll start talking about the longer term record, which is like a major multi-bagger. Like from $20 or something, 15 years ago to $1,900 today. Just huge.
Yeah, I believe it's 100-bagger now. I think if it's not, it's very close.
Yeah. So I just grabbed a max chart in Yahoo real quick. December 07, $25, and the price quoted here as I watch it is 1931. So, it's not 100, but who the hell cares?
Yeah, exactly. Yeah, we own that in the fund. And the more and more I learn about that company, the more and more I admire and respect what they've done. So, and owning Constellation, also they had a spinoff of a company in the Netherlands called Topicus. And so if you own Constellation, you also got shares of Topicus, which I think you got them, your cost basis was somewhere in the 20s, and it opened, I want to say maybe somewhere in the 50s. And today it's about $90. So it's the gift that keeps on giving. It's really a remarkable company, those guys, and the way they allocate capital, the way they think about it. It's exactly the kind of thing you want to have. And their incentives are well aligned. The way they incentivize their people and management team on return on invested capital plus growth. And they have high hurdles on what they'll invest in, really too high. And recently they've lowered it, which I think will give it a little extra rocket fuel. Because they were really high before, 30%, let's say, and now maybe they'll take it down to 25, which would still be a remarkable result. And you want them to invest as much of that cash flow as they generate as possible. What they had done a couple of times in recent years was pay a special dividend. But of course, if you have a business that can reinvest and earn 25, 30%, you would rather they reinvest as much as possible.
Right. So if I didn't already know that you were talking about a software company, I think you were talking about, a Berkshire imitator or something. I think you were talking about a holding company.
Yeah. It is kind of like, I have described it to my investors before as the Berkshire of software companies, because it is a holding company and they invest in software companies, wholly owned for the most part, but not always. And so they own hundreds of software companies now across the world. And Topicus is a spinoff that's mostly focused in the Netherlands and Northern Europe, but otherwise it's the same kind of model. And then this company, Vitec. So Constellation is what? I don't know, $35 billion market cap company, Canadian anyway. And Topicus is another few billion. And then this Vitec is even smaller. I think it may be $1.5 billion, something like that in US. But similar model. They are kind of a holding company that then invests in smaller software companies. And these are software companies that are called vertical market software companies, or VMS. So it's different from horizontal. Horizontal market software would be stuff people probably know about, like Excel spreadsheet is horizontal because it means that you can take an Excel spreadsheet and use it in any industry. It's industry agnostic. It's not set up for any word processing, anything like that. Where vertical market software is custom tailored to a specific narrow industry. So it might be, how to run a school. There might be software around specifically geared for property management companies, or software specifically geared towards running a gym or health club or something like that. So there's lots and lots of these around, and they're great businesses because once they're implanted, they kind of become the dominant standard, and people don't switch. And because they're such niche businesses, larger software companies don't bother going after them. So, and there's all kinds of regional differences. So, if, Vitech is focused in the Nordic region, so there's language barriers. It's not so easy. Even if you had a great software to run a beauty salon in the US, it wouldn't necessarily translate so well in Sweden. So these businesses are moaty, they're long-term, they got regular price increases, they don't require a lot of capital. I mean, it's all good things if you're an investor. You're like, wow, I want that.
Yeah, absolutely. And you want four things in particular, though. And we always talk about these when you come on the program, but we should review them, I think, just for any listeners who might not have heard your previous interview or might not be familiar with you. What are those four items that you call the code that you look for in every company you invest in?
Yeah, so C.O.D.E stands for cheap. So I want an attractive valuation to start. O is one of the most important, and that's for owner operators. Basically, I want to invest with people who have skin in the game. D is for disclosures. So they have public disclosures have to be something we can follow and understand. And E is for excellent financial condition. So I don't like to take balance sheet risk. All the companies I like to own have no debt or very little debt. And then I overlay on top of those things. I look for, a quality business, something where there are good returns on capital and the ability to reinvest. So if you put all that together in a blender, you have a Woodlock House cocktail. And so ideally, I'd like to own these businesses for a long time.
Forever, even, maybe.
Forever, even, yeah. That would be ideal if I could own something and just, never sell it.
So the first, code C.O.D.E, the first one is cheap. And I feel like that's the hardest one to do nowadays.
Well, I would agree with that. And I would also say that I think a lot of investors focus probably too much on raw multiples and don't necessarily consider that. Most people understand that a higher multiple will go with something that grows more. So you always have to keep that in mind. But there's also the return on capital component. And a lot of times if a business is trading at 35 times earnings, let's say, or cash flow versus another business that might trade at 20, it's because the business that's 35 times is generating a lot higher returns on capital or is less capital intensive. And so, you have to kind of learn to put these things on a sliding scale, something that, because some of these great businesses never look cheap on the surface, and yet they continue to just grow and grow and grow. I know we own Hayakawa, for example, as a stock that's almost never looked cheap, but has been a very good compounder for a long period of time. Copart is another one we own. Similar, just recently put in 52-week highs, but again, never really looks cheap. So some of these businesses are like that. And so cheap, when I say cheap, I become less focused on present day multiples, and I mean cheap more in relation to kind of price paid today against what I think maybe the sum of future cash flows discounted to today. So, that's basically what every business is worth, is that. And it's more, it's a theoretical to say it. Obviously, to know that you can't know what cash a business is going to spit out over its life, but that's how the framework you have to think about it. And if you think longer term, some of these businesses that may look expensive today start to look cheaper because you see the compounding effect of their ability to earn those high returns and reinvest, and the consistency of them being able to do it. Another business that I've come to admire a lot that doesn't really have a high return on capital. I think it's one you have too in your portfolio, Brown & Brown, insurance brokerage. Yeah. Those guys. Yeah, I love it too. The thing is, they don't earn that high a return. I think their ROE is 12%-ish, and that's probably a good way to think about it. But they're so consistent, and they're so good at capital allocation, so opportunistic about it. And just so smart the way they run their business. That you look at a long-term chart of something like Brown & Brown, it's just steadily up and to the right. So I love those kinds of things. Brown & Brown also, I should say, is family owned. And Powell Brown is the grandson of the founder. He's the current CEO. And they've been very disciplined about their balance sheet. They're opportunistic. In 2018, December 2018, when the share price took a dip along with everything else at the end of that year, they quickly put together a buyback authorization, bought back some stock. I mean, I'd love to see that kind of thing.
Yeah. And again, I guess it's just too easy to refer back to the example of Berkshire Hathaway. When Brown and Brown makes an acquisition, and it's just sort of they kind of leave it alone. They integrate it in somewhat. You want to be able to spread cost across the greatest possible base, but they don't mess with the good thing that they've acquired, generally speaking.
Yeah, and they have good incentives. So when they buy something from somebody, they're not just buying it and then the guys who run it go away. They stay aboard. They have earnouts so that they stick around and will still work hard and make the business work, and it works for Brown and Brown. So I like the companies that acquire and that not just are pure roll-ups where they're buying somebody out completely and the pre-existing owner walks away, but where they're able to use incentives and harness the talent that they're buying. And Brown and Brown's great at that. Hayakawa is great at that. They often leave the existing management team with a significant ownership stake in the business that they acquire. So they get their skin in the game that way. But the really good acquirers have a way of doing that. They have certain formulas. They have a way to reap those, and a way to use incentives to get the best out of people.
And Heiko, just Chris, for the listeners' benefit, this is ticker HEI. That Heiko?
Yeah, that's right. And Heiko is it's another kind of holding company structure. I mean, half of their business is roughly aircraft replacement parts, and that's actually a very good business once you get approval from the FAA. It's not easy to just decide to go build aircraft parts, much less get anyone to buy them. And they've never had a failure in any of their parts, so that's a good business. And then the other part of their business is electronics technologies, where they're involved in all kinds of things, pumps and motors, and sometimes things that they're involved with the U.S. Navy, or things that are involved with satellites. So that's another segment or another part of their business. But you put all that together, and that's another business that's very efficient with return on capital and all the good kind of things we like to see as investors. The Mendelsohn family owns it. It's a father and his two sons. And, there's plenty of stories if you read past letters or you read transcripts about, like you used to hear stories like this with Microsoft about how secretaries become millionaires because they started with the company, stick with it, and the company, they employees own a piece of it as well, and they're able to participate in the upside. So I like those kinds of stories. Culture's an important part of the research process for me. Is trying to get a sense for, how's the work at this place? Do people like working there? Do they stick around? What are the incentives like? And those little things like that really add up over a long period of time. And that's why you can have these just remarkable results, something like Constellation Software or Berkshire or Brown and Brown. It's more than just numbers. I'm sure if you go back in time, you could have found other insurance brokerage companies that were somewhat in Brown and Brown's spot, but nowhere, not forgotten today, or nowhere near the success Brown and Brown has had. And we've talked about there's not been a lot of Berkshire imitators. So, it's not so easy to duplicate that culture.
Yeah, maybe you hit on the reason why just there at the end. It's trying to imitate the culture is too hard, and financial people in general just don't want to operate that way because they all want to, use the wrong kinds of leverage. Buffett used leverage, but he did it in the form of float. And they all want to, make everything work every quarter, so that the optics look good for the Wall Street analysts.
That's right.
So we don't get a lot of imitators, and it's strange. We talked about, I've talked about this with other people, and it comes up regularly. Why don't more people do this? And why don't more people have this, like they call it a culture of seamless trust, Like Buffett, and Munger, they onboard a new company, they buy a new company, and there's this seamless trust that they know they've chosen well, so they're going to trust completely and not try to run that company. They bought it so the guy that in charge could continue to run it. And also at their head office, which I think has a grand total of like 20 people or something. It's this culture of seamless trust. What does that say about us, man? Nobody in finance wants to do seamless trust.
I mean, it says that people like that are pretty special. and it's hard to replicate that. And for so long, because, somebody like obviously Buffett and Munger have been doing it for a very, very long time. And I suspect there are people who can do it for a while, but there's some temptation somewhere along the way. And maybe they get off track that way, but to do it for so long, that's the other thing that's remarkable about a lot of the companies we're talking about. It's not like they've been great for 5 years. They've been great for 20 years, 30 years, Berkshire's case half a century.
Yeah. Decades and decades, half a century. It's amazing. And all the things you're talking about and, the phenomenon of Berkshire, it's all about this idea of compounding effects. It's the difference between knowing what that difference in culture. It's the difference between understanding the extremely high value of those long-term compounding effects that you get when you're real careful to allocate to a business that has higher returns on capital, right? Because when you don't, you get like Japan. And I think you and I have talked about this before, right? So the returns on capital are like 2%. So you're perennially getting these Japanese companies that are like nets, less than the net current assets and the net cash and stuff. But on the other end of it, you're saying, you're justified in paying whatever it is, 35 times cash flows or something,
right,
for a company that can do 30% or 40% on capital or something over time.
Yeah, I mean, it's interesting to bring up Japan. It is. I've looked at Japan many times. Always something comes up, but that's always something I struggle with. Is culturally, there are so many companies that are just different there, and they carry a lot of cash, and so it really drags down the compounding you get as an investor.
You know what the funny thing is, Chris? The funny thing is that culture is long-term oriented beyond anything that we are familiar with in the United States.
Yeah, and that was what I was going to say.
The compounding is not great.
That's right. In fact, I was going to say there's a book out, and I blogged about this a while ago. You may remember it was Century Club or Lessons from Century Club Companies. And I mean, of course, Japan has a outsized number of companies that have been around a long time. In fact, they have a bunch of companies that have been around for more than 1,000 years. So, but that book was an interesting study because it had, what it tried to kind of tease out. What are some of the things that might predict that a company's going to be around a long time, or what are some of the traits of these companies that have been around a long time? And of course, a lot of it was cultural, but it had little tidbits that I thought were interesting and things that may help you look for these things. So one of them I remember had to do with these long live businesses had close relationships with certain business partners. So I remember that, for example, there was a shoe company that had gotten its leather from the same company since like 1930, and there was another, lumber company that had been doing business with a construction company for like 50 or 60 years. So they have these close corporate partnerships that have also developed and stayed for a long, long period of time. That can also be a clue that perhaps there's something special there about the culture of those firms.
Right. They're focused overwhelmingly on survival.
Yeah.
But, the thing is, though, they're focused on survival, but they wind up kind of being really way too cautious about allocating capital a lot of the time, I think.
That's right.
And that's why you get those low returns on capital. But look how, robust, or even we might even say anti-fragile if we had Vitaly Katzenelson in the conversation.
Yeah.
How robust these companies are that do earn, like Berkshire. It's hard to put a dent in Berkshire. It's a really robust company. It's built for survival, and yet it's also built for the higher returns on capital. So they're not mutually exclusive.
That's exactly right. I agree with that 100%. They're not mutually exclusive. And, Constellation Software is the same way. I mean, you look at what they've done it without leverage. So it's just remarkable to have Hayako is another one that's minimal leverage. So these people have built high return businesses without any financial leverage, maintaining bulletproof balance sheets the whole time. It's amazing.
And we have to mention, Chris, don't we, that you can't do this in every industry, right? They picked the good industries, didn't they?
They did. Yeah, that's also a good point. So certain industries are just going to be a lot more difficult, I suppose. Like think about, let's look at it would be really tough to build something that great in, say, auto manufacturing. Pretty tough business, very cyclical, capital intensive.
Yep.
I'm sure we could come up with a lot of examples of industries that are just really tough. But then there are always exceptions. I mean, you look at airlines, you would say that was a pretty poor business, but then Southwest has been pretty successful. So there's always exceptions, but in general, yeah, industry matters quite a bit. Industry affiliation, yeah, maybe that's a main factor.
I'm glad you mentioned Southwest because really, I don't think you can separate the low price model from the longevity of it and from the fact that it's in this commodity business, right?
Mm-hmm.
Like there are limited ways in a commodity business that you could find that kind of success, and ultimately, like if you don't have the rock bottom price most of the time and basically build a model that can handle that, and they did it. They used like the same airplane. Everything is the same airplane so they can buy it in bulk and fix it in bulk and maintain it in bulk and whatever. And other things too. It's all the industry really, I think, kind of dictated the model to a great degree.
Yeah. And, there's some great stories early on about some of the decisions Southwest made, Herb Kelleher and his gang, that are fascinating to read about. That reminds me, there's one other book that could pass out to your listeners called The Intelligent Fanatics Project. And that has some great stories about Southwest and Soul Price at Price Club, other businesses as well. But, you learn about how Southwest came from this really scrappy start, and how they bested some bigger, well-funded competitors, even when they're in their own state. When they started, like Texas, they beat Braniff Airlines, which, was quite a feet. So, I don't remember. So I remember one story in particular where they had the same route with Braniff, and I don't remember what the route was, between two Texas cities, and they were cheaper, but Braniff then matched their price. And so Southwest, was trying to figure out what to do. And they came up with this idea where they figured out that a lot of it was business travel. And so they offered, it was a slightly higher price, but they offered their passengers a choice of an alcoholic beverage, something like, a fifth of whiskey or this or that, the other thing. There's like three or four different choices. And that proved very popular. So because the business travelers were okay paying slightly higher fare, because then the people who are on the plane get to keep the whiskey. And for a little while there, Southwest was the largest alcoholic distributor in the state of Texas when they ran this thing. So it was creative stories like that in the early going too that solidified Southwest's position. There were a lot of interesting little decisions they made along the way. That it's a good case study in how to make it in a very, very tough business.
So, Chris, you've actually given us quite a few names, like Constellation, Topicus, VTech, Copart, Brown and Brown. Just for our listeners' sake, because I know they're curious, I know what they're thinking. Is there one of those names or some other name right now that you are particularly excited about at recent valuations as a new investment?
Yeah.
No, that sounds like a no.
That's an interesting caveat. Yeah, because the last two businesses that I bought, or in the first quarter, I bought Topicus and I bought Evolution Gaming in Sweden, online casino. And both those have moved up quite a bit since I bought them. Topicus is maybe up 40%. Evolution's probably up I don't know, similar amount maybe. So, I think all of these are still great businesses to own long term. I know people are generally put off by things after they've run, but as I like to remind people, I did that book 100 Baggers, and that was a study of the best performing stocks over the 50 years or so before, and it added on to the study that Thomas Phelps had done, 100 to 1, which looked at all the stocks that had gone up 100 to 1 from like 32 to 72, whatever he published that book. And one of the things you learn is that a lot of these great stocks and best performers spend a lot of time at 52-week highs, which makes sense, right? I mean, if you're going to be one of the best performers over a long period of time, you're going to be putting in 52-week highs pretty regularly. So I would say don't be put off by stocks that are near their 52-week highs. And so, I like all of them. As I say, I haven't. Actually, yeah, I did add a little bit to evolution on the dip. So there you go. I mean, that is an interesting one. And their earnings are going to come out here probably in a week or so. I would get in ahead of that. I suspect they're going to have really good earnings. They did a big acquisition. Those numbers will be in their report. And it's just a company that continuously knocks it out of the park. So I really like that one. It's basically online casino. It's become very, very popular. It's a global phenomena, and they're the best at it, miles ahead of their competition. Again, there's a lot of insider ownership, great balance sheet, and really, really high returns on capital. So it has all the things we talked about. And I'm pretty excited about that position.
All right. Wow. And there may be a short-term catalyst in the form of earnings. I mean,
yeah.
What more could anyone want? We've been talking for a while, and it's time for the final question. You've been through this exercise once before, but I'll ask the question. I'll restate the question, and it is simply, if you could leave our listener with one idea, one thought today, what would it be?
One idea or one thought? Well, let's leave them with the idea to be very patient with your investments, to spend a lot of time thinking about what you want to invest in, and then when you invest in, leave it alone. I'm always amazed when I look back and in researching different stocks and things, what they're able to do over a long period of time. Long period of time meaning, let's say, a decade. Sometimes it's very hard to model these things, and it's just such a surprise when you have a good business and a good company, and what they can do over a 10-year span. But of course, you're not going to get that benefit if you're constantly looking at your stocks and making changes. I mean, you mentioned Constellation, which a decade ago was trading at probably $60 a share, and today is $1,900. And how many people modeling, quarterly earnings and fretting over everything back then could have possibly imagined that the stock would be up that much? So time is the essential element, and patience is key. So I would just say, at least for some piece of your investments, be patient, leave it alone.
Excellent. Absolutely. Equity is a long-term investment.
It is.
By its nature. All right. Well, thanks. Thanks a lot for that, and for coming back and talking with us.
Dan, anytime. I always enjoy talking to you, and hope your listeners get something out of what we talked about. I know there's a lot of stuff in there. So, and of course, they can always find me on Twitter. So I'm there, and my blog. So I'm out there and available as well.
Yeah. Hey, everybody. I'm serious. Follow Chris Mayer's Twitter feed. It's really excellent. So thanks a lot, Chris. And I guess we'll talk to you again soon.
Yep. Take care, Dan.
Always a pleasure to talk with my old friend Chris Mayer. Chris and I got into the newsletter business around the same time. Not too far apart. I think he got in a few years after me, and I've been at it about 24 years now. And so maybe he was at it like 20 years or something. And he and I were on the value side, and we had this funny thing going where his picks did well and my picks did well, but when we both picked the same stock, it was a real dud, like almost every single time. And I'm really happy for his success. He's turned out to be, in my mind, of all the investors who sort of came out of the newsletter business, right? Some investors go into the newsletter business, but some people go into the newsletter business and then they come out of it as professional investors. And Chris is like tops. To me, he's number one of all the people who came out of it. That approach of his, that disciplined, long-term approach, it's unbeatable. That is how the big money is made in stocks. People talk about trading and trying to make money over a week or a day or a month or even a year. Even a year is too short. And so Chris he's not anywhere near that. You heard him say 10 years, right? Be ready to hold for 10 years. Don't go in every quarter looking to make a move and sell or buy or something. Once you buy a stock, hang on to it for a long time. And that's it's always the simple advice, that is the most powerful, but usually, with investing, emotionally the most difficult. The other thing besides patience that he talked about that I think is super important, you can't emphasize this enough. You heard us talking about the difference between companies that earn low returns on capital. We mentioned Japan. These companies are perennially cheap and they get, when the market's down, there's a whole bunch of them and then the market's up and there's still a few of them left. And they earn really low returns on capital, like low single digits. And they always have a lot of cash that they're not using versus the companies that Chris mentioned, the Constellation, Hayakawa, Copart, Brown & Brown, and we mentioned Berkshire Hathaway, same thing. They put their cash to work in very good, high return on capital businesses. And learning that difference alone, it's just about the single most powerful thing you can do. You combine that with patience, and it's not hard to make money in stocks, except emotionally. It's not technically difficult anymore once you learn that, but emotionally, it's always the same challenge. The market's down, your stocks are down, you want to sell, you feel like you're losing money, you feel bad. But if you're holding those really great businesses like the one Chris mentioned, and many others, that we could mention, and we even mentioned Constellation, the beverage company that I've recommended in my newsletter. These are great long-term holds, and you have to learn how to do that to make the big money in stocks. Great talk. I love talking with Chris. It is always highly productive. He gave us lots of names. He said you could buy Evolution Gaming now, and it's probably a really good long-term bet still and might have a good short-term catalyst with earnings coming out soon. Really, really great talk. All right, let's take a look at the mailbag. Let's do that right now. I want to share a quick story about a man named Ken Langone. The son of Italian immigrants, Langone describes himself as a dumb kid from Long Island that barely got out of high school and almost flunked out of college. Langone's dad was a plumber. His mom worked in a school cafeteria. But Langone lived the American dream. He went from $82 a week to one of the richest people in the world. Langone's most famous move was an early investment in Home Depot, which enabled him to become a co-founder of what is now the biggest business of its kind in the world, with 2,000 plus stores and 400,000 employees in North America. Because of Langone's Home Depot connection, he has unique insights into the current status of the U.S. economy, the labor shortages, supply chain issues, soaring prices, and increasing inflation. And that's why it was telling to see Ken Langone go public on CNBC recently with an alarming prediction. He also says the government is already creating major distortions and that the people they are trying to help are the ones who are going to get hurt the most. And my colleague, a former Goldman Sachs banker, Dr. David Eifrig, agrees. He says most Americans are completely unprepared for what's about to take place in our country. What exactly is going on and what has these successful and wealthy Americans so concerned? Go online to get the facts about this urgent warning by visiting www.loomingeconomywarning.com. That website again is www.loomingeconomywarning.com. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows and respond to as many as possible. You can also call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Lots of good stuff this week. And just generally speaking, there were lots of emails that said they really enjoyed last week's interview with Lawrence Lindsay. If you haven't listened to it, you might want to check it out. First up this week is Al M. Al M writes in all the time. I love his emails. And he's got a simple question. He says, you do recommend buying gold and silver through Fizz and PSILV, but they are falling. So what gives? All the best, Al M. So Fizz, PHYS, and PSILV, PSLV, those are the ticker symbols for the Sprott gold and silver trusts, respectively. And, well, Al, they just rise and fall with the price of gold and silver. That's all there is to it. So that's why the share price of those things rise and fall. Why it's happening lately? Hey, man, you know me. I'm long-term with gold and silver. I just buy it intending never to sell it. So that's all I can tell you, Al. That's it. It's a long-term holding. Rising and falling in the short term is just none of my concern at all. But it's a good question. Next comes Mike B. And Mike B says, hi, Dan, longtime listener and Alliance member. I was disappointed in your answer to the gentleman that wanted to know how to short the market. This was a question in last week's mailbag. Mike B continues, you failed to mention the easiest way of all, inverse ETFs. Simple as buying a stock without the margin requirements of shorting stocks directly or using futures. Doesn't have the big bang reward of put options, but certainly can give exposure to the short side, and the risk can be controlled with proper stop management. Take care, Mike B. There you go, Mike. I don't need to say anything more than that. And you're right, I failed to mention it. Shorting is hard. It's not for most people. Most people should not do it. Next comes Mike W. And Mike W. says, hi, Dan. Really enjoyed the latest episode with Lawrence Lindsay. His provocative final thought about the next decade being a scramble for survival has been rolling around in my mind ever since. And then he says he's either contemplating buying permanent life insurance or somebody recommended that he buy it. Then he says, permanent life insurance seems to make sense during an era of sound money and permanently low inflation, but it looks to me like we have left that era in the rear view. I know you can't give specific advice, but what's your take on permanent life insurance in general, but especially in an era of inflation? Thanks in advance for reading and keep up the great work. Best, Mike W. I have insurance. I have life insurance, but I didn't get it until I was in my late 50s. So maybe I'm you say you're in your 30s, you and your wife are in your 30s and you're healthy. So it's a good question. My only question for anybody about life insurance is, is it something that you would be okay not having? That's the only really general thing I can ask about this. If you're not comfortable not having it, then, you might want to get it. If you're comfortable not having it because you've got plenty of net worth and you know that if something happens to you, for example, that your spouse will rather easily inherit and take over your assets or whatever, it won't be a big problem legally, then, maybe you don't need it. But as far as inflation goes, again, inflation can become terrible, right? And over your lifetime, if you're 30 and you live to be 90 or 100, 60, 70 years. Well, first of all, if you live to be 90 or 100, the life insurance probably isn't going to do your spouse a lot of good. maybe I don't know if they're going to live to be 90 or 100 either, right? So, but at some point along the way, it may be something that you'll be glad you had, or that your spouse will be glad you had. But the inflation question is a good one, and I believe that my question still covers it. Even with inflation, will you be okay not having it? Put it that way. And the answer is up to you, Mike. But as you can tell, I'm struggling with it. It's an excellent question. And that really is the only way I have of addressing it. right? Because if you have a $200,000 life insurance policy now and say something happens to you, you pass away in 40 years and inflation was really vicious for the next 40 years, 200,000 might feel at that time like, 20,000 feels today. It might feel like nothing. So, it's a good question. And that's all I got for you. Thank you, Mike. That's actually a really good thought exercise, and I hope everyone listening sort of thinks about it themselves. Edwin M. is next. He says, "Good morning, Dan." Well, good morning, Edwin, wherever you are in the world that it's morning. "I just got done listening to your interview with Lawrence Lindsay, and I must say his final thought about the next decade being a fight for survival is how I have felt for the last few years. The one thing I would have liked to hear you bring up is crypto. This, in my mind, is the wild card in the next decade." And then he mentions China's and our own monstrosity of a government's wild quest for total dominance and control, and says, "Could this, crypto, be humanity's last chance at freedom as our founding fathers envisioned? A people mostly free from government manipulation and control of the essential necessities of life, liberty, and the pursuit of happiness? Would love to hear your thoughts. Sincerely, Edward M." Well, Edward, this strikes me as a request for a prediction, right? Could this, but you are framing it properly. You say, could this be? Sure, it could be. But my perspective is, whether it could be or not, you're prepared for whatever crypto gets you by owning some. That's the very best that I can do. I can't tell you what the future is going to look like. But if I put a little bit of money into crypto and it becomes, if it becomes not so important, well, then my other assets should take care of me, right? If it becomes extremely important and there's the one thing you need to have, my assumption is that the value of, say, Bitcoin, the number one, the biggest crypto by market cap, I would assume the value of Bitcoin would be much higher than it is today. So, having a little bit now could get you a major, major multi-bagger and protect you against whatever else is happening in the world in the future. And those are my thoughts, Edwin. That's the best that I believe I can do. Could it be humanity's last chance at freedom as our founding fathers envisioned? And it makes sense that you're saying, well, if we have Bitcoin or whatever crypto you like, if we have Bitcoin, let's just say, and the US dollar continues its long, slow slide to nothing, and maybe accelerates, and maybe this big sort of looming thing that people talk about, the US dollar losing its status as the global reserve currency, maybe that happens or begins to happen during our lifetime. So things change a lot, and those other assets I mentioned maybe are impacted negatively by that. Certainly, the government would be in major clampdown mode and major, what did we talk about with Lawrence Lindsay? Taxation and confiscation mode, right? So having crypto could help you out, but, if Bitcoin turns into the world's currency, it's not going to make us all free, politically free. So, I don't think it is anyway, but it's an interesting thought to contemplate it that way, Edwin, and I thank you for the question. Lots of good stuff this week in the mailbag, just for, food for thought. I hope when you finish the podcast this week that you'll think about some of this stuff, because there are really good questions. Is permanent life insurance for you if you're 30 years old and we get inflation for the next 50 years? It's a question worth asking. And what about crypto? As Edwin M. was asking, is it going to make us all free in the future, or should we just have it? It's there's lots of good stuff this week in the mailbag. So I hope you're as excited about it as I am. Let's just put it that way. And I hope it gives you food for thought too, and that you enjoy it, because that's another mailbag. And that's another episode of the Stansberry Investor Hour, and I hope you enjoyed it as much as I did, and I really did. We provide a transcript for every episode. Just go to www.investorhour.com. Click on the episode you want, scroll all the way down and click on the word transcript, and enjoy. If you like this episode, send someone else a link to the podcast so that we can continue to grow. Anybody you know who might enjoy the show, just tell them to check it out on their podcast app or at investorhour.com. And do me a favor, would you? Subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. Follow us on Twitter, where our handle is @investor_hour. If you have a guest you want me to interview, drop me a note, feedback@investorhour.com, or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.